All right, listen closely, because this is something every trader needs to understand before they start throwing their capital at every candle that moves on the chart. In the previous video on Rule 51, Cut Losses, Grow Profits, we talked about the discipline it takes to stop a bad trade before it eats your account alive. That was the defensive part of trading, the part most folks never learn. But today, we're going to talk about something just as critical: how to protect your profits once you've got them. Because believe me, making money in the market is only half the battle. Keeping it is where most traders lose the war. Now, let me ask you something right at the start. How many times have you been in a trade that was going your way, and instead of taking the gain, you held on a little too long, just waiting for one more uptick, one more point, one more push, only to watch the whole thing turn around on you? You had the profit in your hand, and the next thing you knew, it was gone. I've done it myself, more times than I care to count when I was young. Every trader learns that lesson the hard way at least once. You see, protecting profits isn't about being timid. It's not about snatching your gains the moment they appear. It's about discipline. The same discipline you use to cut your losses. Only this time, it's to preserve what you've earned. The market will tempt you with more every time you're on the right side of a move. That's its job. But a trader's job is to know when enough is enough. I used to tell young traders, the big money is made by sitting. But what most of them forget is that sitting doesn't mean sitting blindly. You can sit in a winning trade. Yes, but only if the market is still confirming your reason for being in it. The moment the character of the move changes, you have to change with it. The tape never lies. The chart never lies. It's only your hope that lies. Now think of this. You're in a long position, and the stock's been trending beautifully for days. You've added to your line as it confirmed strength. Everything looks fine. Then one morning it opens strong, but instead of holding those gains, it fades back by noon. The volume swells on the downside. That's the market whispering to you. It's saying, be careful, something's shifting. What do most traders do? They shrug it off. They call it a pullback. They say, oh, it'll come back. But the tape doesn't whisper twice. It tells you once, and then it moves without you. Tell me, why would you risk giving back weeks of work just because you didn't want to listen to the tape? Isn't that the same stubbornness that destroys traders on their losing trades? You see, the rule for protecting profits is really the twin brother of the rule for cutting losses. The same mindset applies: never argue with the market. When it tells you your trade's over, you get out. Not half out, not later, out. You protect your gains like a fortress guards its gold. And let's talk about those trailing stops, because everybody loves that term. They set a stop 3 or 4 points behind and call it protection. But it's not about mechanical stops. It's about market logic. If you bought because the trend was strong, then you stay in as long as that trend stays strong. But the moment the chart tells you momentum's fading, the volume's drying up, or the price action's turning heavy, you start scaling out. You don't need to be perfect. You just need to be practical. There's a big difference between taking profits and protecting profits. Taking profits means cashing out too early because you're afraid to lose what you've made. Protecting profits means managing your position smartly as the market shifts. That's what professionals do. The amateur tries to pick tops. The professional reads character changes. Let me paint you a picture. When a stock's moving in your favor, your paper profits feel light, easy to carry. But once it starts to slip, those same profits grow heavy in your mind. You start thinking, maybe I should have sold. You start hoping again. Hope. That's the oldest disease in the trading world. The only cure for it is rule-based discipline. That's why these rules matter. They're not optional. They're survival tools. Now, a lot of people ask me, Jesse, when do you know it's time to sell? And I always tell them, the market tells you, not your broker, not your gut, not the headlines. The tape gives you signals. Watch the volume. Watch how prices react to strength or weakness. If you see heavy volume on a decline after a long rise, that's distribution. If the stock stops making new highs, even when the market's strong, that's a warning. When those signs show up, you don't wait around for confirmation from the newspapers. You act. Do you know why so many traders lose their profits? Because they treat unrealized gains like imaginary money. They think, it's not real until I sell. That's nonsense. It's your money the moment the market gives it to you. The only way you lose it is by refusing to protect it. And remember, the market doesn't owe you continuation. It doesn't have to reward your patience. It rewards understanding of conditions, of timing, of psychology. Protecting profits isn't about fear, it's about respect for the market's power to take back what it gave you. When I was trading heavily, I learned to think in probabilities, not wishes. Every trade has a lifespan. When that lifespan ends, I let it go. I didn't marry my stocks. I didn't fall in love with my winners. You can admire a stock's strength, but you can't get sentimental about it. The minute you do, it'll break your heart and your account. Now, let me ask you something. Do you think the market cares about your opinion? It doesn't. It doesn't even know you exist. So why should you trust your feelings over its facts? If the market tells you the move's ending, take it seriously. That's how you stay in the game long enough to build wealth. Protecting profits means you think like a businessman, not a gambler. A gambler bets and hopes. A businessman manages risk and capital. The market's a business, a tough one. If you don't treat it like one, it'll treat you like a fool. Sometimes, I'd see traders double their accounts in a single move, and instead of locking in even half, they'd let greed take the wheel. This is the big one, they'd say. But there's no such thing as the big one. There's only the next trade. If you protect what you've made, you're ready for it. If you don't, you'll be too busy nursing your wounds to take advantage of the next setup. And here's the truth: wealth in trading isn't built by hitting home runs. It's built by compounding discipline. You grow your stake, protect it, grow it again, and repeat. Just like we discussed in the last video about cutting losses, that same rule is mirrored here. When you cut losses, you protect capital. When you protect profits, you protect progress. Both are essential to long-term survival. Now let's talk about another mistake. Giving back too much after a big win. Every trader's done it. You have a great month, and you start feeling invincible. You start increasing your size, taking looser entries, ignoring warning signs. You think you've got the market figured out, but the moment you let confidence turn into arrogance, the market will teach you humility. That's why, after a winning streak, I always told myself, don't get reckless. Get careful. Do you know when most traders blow up? Not after losses, after wins, because profits make them careless. They stop studying the tape with the same hunger. They think the market's changed in their favor permanently. But the market never changes for anyone. It behaves the same way. It just changes how it disguises the traps. Protecting profits means protecting your mental capital too. When you guard your gains, you keep your confidence steady. You stay level-headed. You don't swing between euphoria and despair. A trader with balance is dangerous. Dangerous to the market's tricks. You must train yourself to think of every trade as a soldier in your army. If you send too many into battle and lose them, your army weakens. But if you send them wisely and bring them home safely, even if they're a little battered, your army grows stronger. Your capital is your army. Protect it fiercely. And here's something else. When a trade gives you a profit early, don't mistake that for brilliance. Sometimes it's just luck. The key question is, can you keep that profit through smart management? Because the market doesn't reward the man who makes the first dollar. It rewards the man who keeps the last. Have you ever noticed how the hardest time to sell is when everything looks perfect? That's exactly when you should be thinking defensively. Because the tape's strength is most deceptive right before a turn. You'll see volume dry up, but prices still look good. That's distribution. The professionals selling into public buying. And if you're not alert, you'll end up buying what they're unloading. That's why protecting profits isn't just about stops. It's about observation. It's about feeling the rhythm of the market reading its language. You don't force your plan on it. You adapt to its tempo. You've got to ask yourself, am I trading my plan, or am I trading my emotions? When you protect profits, you're really protecting yourself from yourself. Because the hardest thing in trading isn't reading charts. It's mastering your own impulses. And this is where today's principle ties back to what we talked about in that first video on cut losses, grow profits. That rule taught you how to defend against loss. This one teaches you how to defend your victory. Both rules are about survival, and survival is the foundation of wealth in this business. You don't have to win every battle. You just can't afford to lose your capital in any single one. Now, some traders say, I'll just ride the trend until it ends. And that's fine, if you know how to spot when it ends. But most don't. They watch the price retrace, and instead of acting, they rationalize. It's just a dip, they say, but dips can turn into dives before you blink. You must be willing to sell when the evidence says so, not when your feelings do. The moment a trade stops behaving the way it should, it's no longer your friend. Don't argue. Don't wait for confirmation that never comes. The tape already told you. You just didn't want to listen. So, protecting profits means staying loyal to your rules, not your trades. And remember, every rule in trading exists to protect you from the worst version of yourself. The greedy one, the hopeful one, the careless one. The market can't beat a disciplined trader, but it can easily beat an emotional one. Now, picture your trading record over a year. Imagine every time you made a profit, you took care to lock in a portion. Half, maybe, while letting the rest run only under strict conditions. Think how much smoother your equity curve would be. That's the beauty of consistency. You might not hit the big jackpot, but you'll build a foundation that lasts. And that's how real wealth is made in the markets. Because wealth isn't about how much you make in a single trade. It's about how much you keep through all of them. Every dollar you protect becomes ammunition for the next opportunity. And the market always gives new opportunities, if you're still standing to take them. Never let a winning trade turn into a losing one. That's one of those rules every trader hears, nods at, and still breaks at least once. Sometimes more than once. It sounds simple, doesn't it? You've got a profit, so protect it. Yet in the real market, with emotions running high and prices dancing, it's one of the hardest disciplines to practice. But it's also the one that separates the professional from the hopeful. You see, the market has a strange way of testing a trader's nerve right when things look best. You've got a position that's been working beautifully. You read the chart right. You timed the entry, the stock's been trending in your favor, and you're sitting on a good profit. Everything looks easy. And that's exactly when the danger begins, because comfort breeds carelessness. The moment you start thinking you can't lose, you've already set yourself up for a fall. When I was trading, I used to say, the market gives you a profit as a test, not as a gift. It's testing whether you have the discipline to keep it. Most traders fail that test because they think the market owes them continuation. They think if it's been going up, it'll keep going up. But the market doesn't owe you anything. It gives and it takes, and the only way to stay ahead is to take before it takes back. Let me ask you something. How many times have you been in a trade that looked perfect, only to watch it reverse and take all your gains, maybe even dip into red before you reacted? You tell yourself, I'll wait for it to come back. That phrase has probably destroyed more trading accounts than any other. It'll come back. Sometimes it does, but more often it doesn't. And even when it does, the emotional toll it takes on you is costly. You start second, guessing every move after that. You lose confidence in your judgment. The next time, you hesitate, and hesitation is poison in trading. Never letting a winning trade turn into a losing one isn't about greed or fear. It's about control. Control over your actions, over your capital, over your emotions. You can't control the market, but you can control your decisions. That's where your power lies. Now, some traders misunderstand this rule. They think it means you should take profits the moment you see green on the screen. But that's not it. That's fear disguised as discipline. The rule means you manage your trade intelligently. You let the move develop, you ride the trend, but you always have a plan, a point beyond which you won't allow your profit to evaporate. You can trail your stop, scale out part of your position, or lock in some gains, but you never let the market turn your success into regret. When you're reading the tape, you'll see clues. Subtle changes in behavior. A stock that's been rising smoothly starts to hesitate near resistance. The volume starts drying up. It doesn't respond to good news like it did a few days ago. Those are signs that the easy part of the move is done. That's when the professional starts thinking about defense. The amateur ignores it, thinking the move will resume. But the tape doesn't lie. The moment it stops confirming your original reason for being in the trade, your job is to protect what you've got. You have to remember the market's not a steady teacher. It's a ruthless examiner. It rewards clarity and punishes hesitation. When you've got a profit, that's not the time to relax. That's the time to sharpen your focus. Because the market will test that profit, and your reaction will reveal who's in charge. You or your emotions. Think of your profits as your soldiers returning from battle. You wouldn't send them back out without a good reason, would you? You'd let them rest, rebuild your army, plan the next campaign. But most traders send those soldiers right back into the fight, unprotected, unplanned, hoping the war keeps going their way. That's how they lose what they've earned. When I made big trades in my time, I learned to always take something off the table once the market proved me right. Even if the move had more to give, I'd secure a portion. That wasn't weakness, that was insurance. You see, a trader's confidence isn't built from making wild profits. It's built from knowing that when he's right, he keeps what he earned. That knowledge strengthens your mindset. It makes you trade better, calmer, smarter. Let me ask you again. Have you ever looked at your account and realized that if you had just sold when you were ahead, you'd be miles ahead by now? Every trader's been there. The chart showed it clearly, but your mind argued otherwise. You convinced yourself to hold, to wait, to hope. Hope. That word again. It's the most expensive emotion in this business. Hope keeps you in trades long after the reason for being in them has vanished. The truth is, the moment you stop managing your profits, you start gambling with them. And the market loves gamblers. It feeds on them. It draws them in with excitement, lets them taste success, then takes it back when they get careless. You can't afford to play that game. You must think like a professional speculator, cold, calculated, objective. Protecting your profit doesn't mean you fear the market, it means you respect it. It means you understand that what the market gives you today can vanish tomorrow if you don't defend it. The best traders aren't the ones who find the biggest moves. They're the ones who keep the profits they make. And don't misunderstand. Sometimes the best protection is patience. There are moments when a pullback is just a pause before another leg up. But you have to know the difference between a healthy correction and a real reversal. That's where your chart reading comes in. The tape shows it. In a healthy move, pullbacks are shallow, volume contracts on dips, and strength returns quickly. But when the market's character shifts, when downswings come on heavy volume, when rallies fail to make new highs, that's not a correction anymore. That's your cue to act. You have to learn to think in terms of if-then. If the stock does this, I'll do that. That's how you stay prepared. Most traders react after the fact. Professionals act on conditions. The best way to never let a winning trade turn into a losing one is to know, before you even enter, how you'll handle success. Write it down. Set your exit zones. Don't improvise when the heat is on. Every great trader I've known had one thing in common. They respected profits like they respected capital. Because profits are capital. They're future opportunity. If you give them back to the market carelessly, you've wasted the effort it took to earn them. There's another danger here. After a few profitable trades, traders often start feeling bulletproof. They loosen up their discipline, thinking their intuition is all they need now. That's when they stop setting stops, stop journaling, stop checking the charts carefully. They call it trusting their gut. But the gut doesn't pay the bills. Discipline does. A trader once told me, "I hate selling early because what if it goes higher?" And I said, "So what if it does? You can always buy again. But you can't recover from being wiped out." That's the mindset you need. Never worry about missing the last bit of a move. The top belongs to someone else. The market will always give you another chance if you still have your capital and your composure. Now, let's look at the psychology of this rule a little deeper. When you're in profit, your brain plays tricks on you. You start imagining bigger numbers, you start counting what you'll buy, you start seeing yourself as smarter than the crowd. That's when discipline slips. Your ego steps in. You forget that the same market that made you feel brilliant can make you look foolish the next day. That's why you must train yourself to stay humble in victory. Humility keeps you sharp. Sometimes, traders confuse holding with patience. Patience is waiting for the right setup or for your trade plan to unfold. Holding blindly is stubbornness. The difference is that patience is based on observation, while stubbornness is based on hope. You can't afford to hope your way through a trade. The market punishes hope. It rewards awareness. If you watch the great tape readers, you'll see how unemotional they are. A trade that turns slightly against them after showing a good profit. They don't wait for confirmation, they act. Not out of panic, but out of principle. They follow their rules. That's why they survive. And remember, this rule, never let a winning trade turn into a losing one, is really about consistency. You can't build wealth in trading if your equity curve swings wildly up and down. You need stability. You need to keep your gains so you can compound them. Protecting profits smooths your growth, steadies your emotions, and keeps you in the game for the long haul. So, next time you're in a trade that's gone your way, ask yourself, what's my plan now? How will I make sure this profit doesn't vanish? Am I protecting my success, or am I just sitting on it, hoping it lasts? The answer to that question will tell you exactly what kind of trader you are. Always scale out when the character of the trend changes. That single line can save a trader's entire year, but most people never truly learn what it means until they've paid for it in lost profits. Scaling out isn't about fear or trying to pick tops. It's about reading the truth in the tape and responding to what the market is actually doing, not what you wish it would do. Every strong move in the market, whether up or down, has a rhythm, a character, a personality. When that personality shifts, your job isn't to argue with it, it's to act. You see, trends don't reverse out of nowhere. They evolve. They slow down, lose momentum, and start showing cracks long before they actually turn. The market gives signs. Not always loud ones. Sometimes just whispers that the tide is changing. A trader who learns to hear those whispers will keep his profits. The one who ignores them will watch his paper gains disappear. Think of a trend like a train moving at full speed. When it's roaring down the tracks, you don't stand in front of it. You ride it. You stay on as long as it moves with purpose and power. But when the train starts to slow, the steam weakens and the noise fades, you don't wait for it to stop completely before you jump off. You step off gradually, safely, while it's still moving in your favor. That's scaling out. You're taking profit while there's still momentum behind you, not when you're already going backward. Let me ask you something. Have you ever been in a trade that gave you a big profit early, and then you sat on it waiting for just a little more? Maybe you even told yourself, it's still trending, I'll let it ride. Then the next day, it pulls back a little. You shrug it off. Then the day after, it dips again, and suddenly your gain is half of what it was. You feel the pressure now, but instead of selling, you wait for it to come back. It doesn't. Before you know it, you're out at break-even or worse. That's what happens when you ignore the change in character. Scaling out means you don't need to predict the exact top. You don't need to be perfect. You just need to be smart. When you sense the rhythm of the move slowing, when volume stops confirming strength, when the chart starts showing hesitation, you start lightening up. You don't dump everything at once, because sometimes a trend will resume after a rest. but you take enough off to protect yourself if it doesn't. That's professionalism. That's trading like a veteran instead of a dreamer. When I was trading actively, I never looked for perfection. I looked for confirmation. As long as the market confirmed my position, I stayed in. The moment it stopped confirming, I began to scale out. Sometimes that meant selling 1/3, sometimes half. It depended on what the tape told me. Because the tape always tells the truth if you know how to listen. Most amateurs do the opposite. They add when the trend weakens, thinking they're getting a better price. They buy dips in a topping move. They sell rallies in a bottoming move. They're fighting the market's change of character instead of adapting to it. They mistake slowing momentum for opportunity. But slowing momentum is a warning, a yellow light flashing before the red. That's when you take action, not when you start convincing yourself that it's just a pullback. Now, you might ask, what does change in character really look like? It can take many forms. It might be a loss of volume on rallies after a strong run that tells you demand is drying up. It might be sudden volatility after a steady move that tells you uncertainty is creeping in. It might be lower highs forming on the chart while the general market stays strong. That's divergence, and divergence is danger. Sometimes the tape just feels heavy. You'll see it. The price doesn't rise as easily as before. The bids don't hold up the same way. That's the character shift. Scaling out in those moments is your way of saying, I respect what the market's telling me. You're not abandoning your position, you're managing it. You're acknowledging that the easy part of the move might be over, and that what's left carries more risk than reward. Ask yourself, what's wrong with taking some profit when the evidence changes? Isn't that why you trade in the first place? To turn opportunity into realized gain. The market doesn't care about your opinions or predictions. It only responds to money flows. When those flows shift, you either move with them or you get caught against them. There's another beauty to scaling out. It relieves pressure. Once you've locked in part of your profit, your emotions calm down. You can think clearly again. You're not paralyzed by fear of missing out or fear of giving back too much. You've already booked success. That mental freedom often helps you make better decisions with the rest of your position. You can hold longer if the trend continues, or exit smoothly if it doesn't. You're playing from a position of strength. I've seen traders freeze up because they went all or nothing. They held their entire position until they were forced out, and by then, the market had already eaten their gains. Scaling out avoids the trap. It's a middle ground between greed and fear. You're not grabbing at small profits, but you're also not gambling with large ones. You're managing risk dynamically as the market evolves. Remember this, every trend, no matter how strong, ends eventually. The professionals don't wait for the official end to act. They start adjusting as soon as the rhythm changes. They can't always tell if the move will fully reverse or just pause, but they don't need to. Their goal is to make sure that when the reversal comes, they're already safe. Do you recall what we talked about in the earlier video on cutting losses and growing profits? That rule was about defense on the downside. This one, scaling out when character changes, is the defense on the upside. Both protect you from the same enemy hesitation. In one case, you hesitate to admit you're wrong. In this case, you hesitate to admit the move is done. The result is the same. Lost capital, lost confidence, lost opportunity. The great traders don't think in absolutes. They don't believe a trend is either alive or dead. They believe it's maturing, just like fruit. You pick it when it's ripe, not when it's rotten. Scaling out is how you harvest your profits before the market spoils them. You take what's ready, and if more ripens later, you take that too. But you never let the entire crop rot because you were waiting for perfection. There's another layer to this, psychology. When you scale out, you train your mind to accept imperfection. You teach yourself that missing the top is fine, that partial profit is real profit. That mindset is essential for longevity. The traders who burn out are the ones who keep chasing the exact high or low. They need to nail it. But trading isn't about nailing anything. It's about surviving long enough to keep compounding. Scaling out also helps smooth your results. Instead of big wins followed by big losses, you get consistent gains. That's what builds real wealth, steady, controlled accumulation. The market rewards consistency far more than boldness. Anyone can catch a lucky run, only a disciplined trader can repeat it year after year. Let's talk about execution for a moment. When you notice that shift in trend character, don't overthink it. Don't wait for the perfect exit signal. The market rarely gives you one. Instead, act incrementally. Sell a third into strength if the tape feels heavy. If the weakness continues, sell another third. If it strengthens again, keep the last piece with a stop that protects the profit. This way, no single decision can ruin your trade. You're not guessing, you're adapting. I used to say the market talks in behavior, not in words. And that's true. The change in behavior is what you have to spot. Sometimes it's fast, sometimes it's slow, but it always comes. The traders who pretend they don't see it are the ones who give their money back